Welcome to Lord and Richards Radio, a program that will enable you to become more financially independent and prosperous from a biblical point of view. Tune in each week to learn how to prosper through good markets and bad. Now, here's our host, Colin Richards, your biblical investment advisor.
Hi, friends. I'm glad to be with you today on Lord and Richards Radio. I'm Colin Richards, founder and president of Lord and Richards. We're a team of advisors who are dedicated to helping people just like you retire financially independent. And we're doing that every single day. On this show, we're discussing investing and planning from the perspective of key biblical principles, a little bit different way of looking at money. We also talk about how to use methods and strategies that will enable you to prosper through both up and down markets. And that's so important in today's volatile world. I'd love to chat with you. My team and I would love to help you, talk to you about your specific questions regarding retirement and saving and investing from a biblical point of view. Just pick up the phone and give us a call at 720-372-0400. Again, that's 720-372-0400. I'd love to chat with you about how you can achieve financial independence from a biblical point of view. Or just check us out on the web at lordandrichards.com. Hi, friends. This is Colin Richards, president and founder of Lord and Richards. And once again, I'm excited to be with you on this edition of the Lord and Richards Show. And today we're continuing our series on what it means to retire with biblical retirement freedom. A little bit different angle on the subject of retirement, because we're not only talking about freedom and being able to do what you love with the people that you love for everything that's important to you, but we're also talking about the key biblical principles that weigh in on that subject. And in earlier episodes, we've described the specialties that are needed for retirement, specialties that really are required for you to enjoy that freedom. Freedom of health, freedom of time, freedom of wealth. And we've gotten through the first two in our previous episodes. We've talked a lot about freedom of time and how what you really need is a distribution or an income specialist, not just somebody who is good at building up a portfolio over the years, but really hasn't learned how to distribute that properly over your lifetime. And in addition to that, we're going to need, for freedom of health, a living benefit specialist, somebody that can show you how to use other people's money to pay for some of those devastating costs that we experience when we experience cognitive decline, or what we call chronic illness. And so we've arrived at our third freedom, which is freedom of wealth. And I know you've been waiting for this one, wanting to hear, well, what do I need to do to have true freedom of wealth during my retirement years, and even in the years preparing for those? So that's our third goal: freedom of time, freedom of health, so that you can enjoy, with good, strong health and access to great care, the freedom of wealth that you have achieved. So here's the principle. Abundant wealth is foundational for the other two. They really work together. Abundant wealth is foundational for both freedom of time and freedom of health. You see, because if we don't do this next piece right, we won't have the money to generate the income to have the freedom of time. If we don't do this next piece right, we won't have the money to be able to afford the care that is needed to have freedom of health, whether proactive care, taking good care of ourselves, getting access to great proactive treatments, therapies, and so forth, or reactive, things like chronic illness. And so what is in the way of achieving what we call freedom of wealth? Well, there's always an obstacle, right? Because what Lord and Richards does is we remove the obstacles that stand in the way of your retirement freedom, whether it's the obstacle from keeping you enjoying freedom of time, freedom of health, or freedom of wealth. Well, the one that's in the way, the obstacle that's in the way of freedom of wealth, is market unpredictability and volatility. You see, the way most of us invest, we've invested the same way, and during all of our working years, we've been looking forward to retirement. We've been gathering up our nest egg. If we've had advice, it's been very much geared towards one thing and one thing only, and that's growth. Very little thought about the other side of the market, right? We like the side that goes up. What do we do about the side that goes down? Because it's very unpredictable and very volatile. Here's our biblical principle for this one. Proverbs 13:11 says, "Wealth gained hastily will dwindle, but whoever gathers little by little will increase it." I like that principle. Wealth gained hastily. Get-rich-quick schemes are the things we've told our kids to avoid. But yet sometimes as I scan the statements of those who visit together with me, I see, you're trying to gain wealth hastily, and that will dwindle. But if you'll gain wealth little by little, you will increase it. And so what can we do to address this? What are the high probability and low probability of success approaches that people take? Because we want to do the high probability ones, right? We don't want to do the ones that leave you scratching your head, maybe running out of money before you run out of life, not having access to money to take care of yourself. So here are the low probability of success approaches. Let's get those out of the way first. So what about cash, right? Let's just keep our money in the bank. If we're worried about market predictability, market volatility, cash is king, as they say. And it is true, especially in the business world, he who runs out of cash loses, right? So cash, be it in bank savings accounts, CDs, money markets, and so forth, or even under your mattress, is a safe place to put money. So we would say security when it comes to cash, very high, right? How about growth? What do you think? Well, I think the growth tends to be below average, right? Typically, even longer term vehicles like certificates of certificates of deposit are only barely keeping up with inflation, maybe a little bit more. And so we're high on security, low on growth. Let me ask you this. In order to grow and build your portfolio, does it make sense to keep up with inflation, but also to grow it over time to be able to keep up with your lifestyle, your needs, your potential healthcare costs? Should we put it all in cash? Probably not. That's a low probability of success strategy. And by the way, when you sit down with us in your Retirement Freedom Review, we will actually map out 10,000 scenarios on these types of things. If you got a lot of cash, we'll see what is your probability of never running out of money before you run out of life. How about stocks? I like stocks. Stocks, right? Growth, high potential. But what about security? Comparatively low. When we're talking about the difference between stocks and cash, there's a big difference in security there. So in exchange for the growth, we're giving up the security. Now, we might ride a stock for a long time. We might pick a winner, but you know what? People who are picking winners sometimes pick losers, and sometimes it doesn't work out so well. So it decreases your probability of obtaining and retaining retirement freedom. So bonds. Okay. How about that growth? Well, most people I talk to aren't super excited about the growth in bonds. Now, there is a category called high yield. Some would go so far as to call them junk, but the idea is that they're a little bit lower rated by the ratings agency. These are companies that you're going to lend money to. That's what a bond is. Think about if your local school system does a bond issue. They're borrowing money from the community to build a school or a playground or whatever. That's what a bond is. So a lower rated entity, one that the ratings agencies such as Moody's are concerned has a lower likelihood of paying that money back to you, may have a higher growth rate to offset that that higher risk. So higher growth, higher risk. But in general, bonds grow slower than stocks. So they're kind of in between stocks and cash. So growth, meh, right? Security. You say, oh, well, I'm all about bonds because they provide security. Well, do they really? Think about 2022 when bonds were down as much as stocks. Now, there is a category of bonds that I'm particularly concerned about, and that is bond funds. But guess what? That's how most of you are carrying your bonds. Whether you're in them through your 401k, through your target date funds in there, right? You set a date for when you're going to retire and they auto invest for you, or whether you're using an advisor and that advisor has put some of your money in bonds to defer risk. Those bonds can actually carry a lot of risk when they're in the form of bond funds because bond funds are liquid, price fluctuates and can drop as dramatically sometimes as stocks. They're not supposed to. They're called non-correlated, but oftentimes they do. In 2022, they did. In 2008, they did. 2000. So we've seen that over and over again. So security low, growth low, right? Now you can own individual bonds and have a promise of your money back, but that's based on the strength of the company that you're lending the money to. Well, Colin, what if I put them together, right? I got a little bit of cash, maybe a bunch of stocks, a bunch of bonds. Well, the most basic form of that, the one that everybody sees all the time, is called a 60-40 portfolio. What is that, Colin? Well, that typically means if you're younger, that means maybe 60% of your portfolio in stocks, 40% in bonds. And again, they're not supposed to correlate. They're not supposed to move together. But guess what? They can't. So we're going to come back in our next segment and talk a little bit about the 60-40 portfolio. But in the meantime, I want you to reach out and schedule your retirement freedom review. It's completely free. I would be delighted to meet together with you, with my team of experts who specialize in the things that you need to obtain retirement freedom. It simply starts with a phone call. Just pick up the phone and give us a call at 720-372-0400. Again, that's 720-372-0400. I'd love to chat with you about how you can achieve financial independence from a biblical point of view. Or just check us out on the web at lordandrichards.com. Hi, friends. This is Colin Richards. And once again, we're back in this episode of the Lord and Richards Show, and we're talking about one of the three critical freedoms you need to obtain retirement freedom. That is freedom of health, freedom of time, and freedom of wealth. And we're discussing the last of those in this segment, and we are walking through some of what we call the low likelihood of success scenarios, the scenarios in investing that are less likely to allow you to achieve freedom of wealth, and by extension, having the time that you need and the health, the quality of health that you can enjoy by investing in yourself. So this is a critical one, folks. So I hope you're paying good attention. And don't forget, you can always catch us online on YouTube to get previous episodes where those have been recorded for you. We also are available on the various podcast sites. So when we're talking about low probability of success approaches, we're talking about things like cash, where although security is high, growth is low, right? So we're not able to keep up. Or stocks alone, where security is low in exchange for much higher growth. Now, if you don't need the money, that's one thing, but most of the people I'm talking to need the money that they're going to use for retirement. And then bonds, which are often mixed together with stocks, but security is not as high as you think. It's often quite low in bond funds, which can be very sensitive to interest rates, as well as growth being low, or at best, meh, right? So what about combining those? 60-40 stock portfolio. Well, here's the problem. Both stocks and bond funds have a low security level. So we're talking low security. Stocks have a high growth opportunity, or at least potential. Bonds, not so much. So the growth tends to be meh, right? It tends to be kind of moderate. And it's really a one-size-fits-all solution that has failed repeatedly. It's unfortunately continually being used by advisors who don't have access to the tools and the strategies that we employ at Lord & Richards to help you achieve both safety and growth together at the same time. And so this is a majority of people, whether they're in target date funds in their 401k, those are funds that automatically adjust your balance of stocks and bonds as you get closer to retirement, making you a little bit more quote unquote conservative, although that's not really the case. This failed in 2007 to 2009. It failed in 2022. It could fail again if this is what you're relying on. I have before me a dozen articles written over the last 10 years, right up to the date, that are telling us over and over again, the beloved 60-40 investment portfolio is now loaded with risk. The 60-40 portfolio is dead. It's not coming back. People who are studying this understand this. Unfortunately, many advisors are limited in what they can offer you and the choice that you have in that. So, Colin, if I can't find success through cash or through stocks or through bonds or through mixing together all three, what is possibly available? Well, the solution is what we call institutional risk management. Institutional risk management. What is that? Well, it's what we've learned, Lord & Richards, from studying the way big institutions invest. These are people like college foundations. Think of Harvard. Think of Yale, think of Princeton, think of hospitals, right? Our local hospitals like the Children's Hospital, local universities, local foundations, local charities and nonprofits. What is the time horizon for how long they need their money to last? If a retiree needs to last throughout a single lifetime, what is a college or a hospital looking at? Well, they're wanting to extend multiple lifetimes, ideally forever, as long as that institution is surviving. Well, then they've got a bigger problem, don't they? Much more difficult. And so I want to learn from these institutions. And it's not as difficult as it might sound. There are studies out there. You can personally go out to a site called commonfund.org, commonfund.org, and you can see how they invest. I'm looking at a chart right now that shows private foundations and community foundations, for example. Well, how do they invest? Well, they tend to put 25 to 30% in U.S. stock, U.S. equities. They tend to put somewhere between 10 and 20% in fixed income, right? That's things like bonds with a fixed payout. They tend to put somewhere between 17 and 23% in foreign equity stock. You say, well, Colin, this all sounds like the stuff you said that wouldn't work, right? Low probability. Well, if that were the bulk of it, but you know what? They tend to invest between 25 and 46% in what are called alternative strategies. You say, well, what is that? Some people affectionately call them alts, A-L-T, apostrophe S for short. Now, some alternative strategies, listen carefully, do involve risk, right? They're things that are outside of the normal realm of what classic investors invest in, like stocks, bonds, mutual funds, ETFs, and so forth. Well, what are these alternative strategies? Again, some are higher risk, but many are about preserving capital, extending the lifespan of the portfolio into the next generation. What are these alternative strategies? Well, not all of these we can use, right? Because some of them require us to have hundreds of millions of dollars. Some of them used to require us to have $100 million or $10 million or $50 million, whatever it is. They had a very high minimum investment, but they've come down and become accessible to us mere mortals so that you can take advantage of it. And these are called principal protected alternative investments, principal protected alternative investments, or at least principal somewhat protected. Right? So it varies. You can go all the way to full protection, or you can add some protection. But the idea here is we're putting a floor at some point under your feet. Somewhere under your feet is a floor of either zero or a certain percentage downside that you don't want to go past. And this used to require huge investments, but now is available. Let me give you an example. So one of these is actually a CD, Certificate of Depreciation. Now, I say that jokingly because many CDs haven't been known for their high earnings potential. And so in our next segment, I'm going to come back and I'm going to describe to you a kind of CD where you can actually get market returns. You're not going to want to miss that. But in the meantime, I'd love for you to put down the radio or the podcast or YouTube, pick up the phone, and call us to set a time to have your complimentary retirement freedom review. At Lord & Richards, we don't charge for this. We don't even charge for our planning. We want our clients to have the best of the best of the best. And this starts for you with a simple phone call. Just pick up the phone and give us a call at 720-372-0400. Again, that's 720-372-0400. I'd love to chat with you about how you can achieve financial independence from a biblical point of view. Or just check us out on the web at lordandrichards.com. Hey folks, welcome back. This is Colin Richards, president and founder of Lord & Richards, and we're in another segment of the Lord & Richards show, and we're talking about high probability of success investment strategies to obtain biblical retirement freedom. And by biblical, we mean we're just basing that on principles from the Word of God, such as Proverbs 13:11, wealth gotten hastily will dwindle, but he who gathers little by little will see it increase. A timeless principle, unfortunately, an often ignored principle, where we're taking excessive risk in our portfolio. And we've learned most of the strategies that we're being taught by our accumulation-focused advisors aren't going to hack it when it comes time to live on that money. So what kinds of things can we incorporate into our planning, into our strategy, so that we can obtain what we call freedom of wealth? That is, to have enough wealth to enjoy the other freedoms, freedom of time, freedom of health, to have the time to do what you love with the people that you love, and to have the physical health and the ability to invest in it so that you can truly enjoy it. Well, to have that freedom of wealth, we've got to remove the obstacle of market predictability and volatility, right? And the solution is going to be strategies that we learn from institutions, endowments. We call it institutional risk management. And I'm giving you a single example in this particular segment so that you can grasp the kinds of things that are now available that used to only be available to large institutions and endowments, such as Harvard University, who was one of the first adopters of what was called the market index or market link CD back in 1987. I'm looking at the article right now from March 18th, 1987, and it was out on the news, AP, Chase Manhattan offering stock market index CD. How many of you have heard of that? Well, I would wager that there are very few of my listeners who's heard of that because it's not advertised. It's a principal protected market link strategy that will allow you to protect on one hand and grow on the other. You say, that sounds too good to be true. Well, here's how it works. Okay. When you get that low guaranteed interest from your CD, are you ever really excited about it? No, you're excited about the safety that you had, right? So you put it there for the safety. So we want the safety, but we also want greater opportunity. Can we put those two together? Why, yes, we can if we'll be willing to compromise in one area, and that is liquidity, right? Because CDs are not immediately liquid when you put your money in. So this means we have to be willing to have a bit of a time horizon. Now, there are other tools, competitors of bank CDs, that offer greater liquidity. But for simplicity, let's just talk about a CD because I think most of us understand the certificate of deposit. So when that certificate of deposit gives the interest, let's call that your golden egg laid by your goose. If you had a goose down in the basement that could lay a golden egg, which would be most important to preserve, the goose down in the basement or the individual annual golden eggs that come out? Most people tell me, well, Colin, I'd protect the goose because that's a non-renewable resource, right? I get one of those, I'm going to get multiple eggs over time. And I would agree with you because we can replace a lost egg. We can't replace a dead goose, right? So if your principal, that is your nest egg, I know I'm mixing metaphors, your principal, let's just call it that, the goose is safe and secure, and it gives us a low guaranteed interest or golden egg each year, then what could we possibly do to amp up those returns? Well, we can let the bank keep that golden egg and reinvest it, not in traditional stocks, bonds, mutual funds, so forth, at a 1-to-1 ratio, getting no leverage, but we can let them invest it in highly leveraged tools such as options. You say, whoa, time out, Colin, options, that's risky stuff. We shouldn't be messing with that with our retirement money. Well, if we were talking about your principal, if we were talking about the goose, I would say 100%. Don't put your goose at risk. Keep your goose safe. Otherwise, your goose is going to get cooked, okay? But if we're talking about a golden egg, since we got so safe with our goose, would it be okay to risk our golden egg in an attempt to potentially get more interest? I would say that's a reasonable bet because what happens if we lose the egg? Well, we've still got our principal. And by the way, we've got all the previous year's interest that we've accrued. So whatever we've earned on that market link CD, we get to keep. And it doesn't go back at risk. It becomes part of the goose and the goose just keeps getting fatter. But if the market goes down and we lose our egg, that means it can also go up. And I see on average in the markets, indexes like the S&P 500 will have 2 or 3 bad years out of 10, typically. Now, doesn't mean we couldn't get 9 out of 10 in a decade, but that's been kind of our historical. So if you're betting on the index going up, that's a pretty good bet most of the time. 70%, 60%, 80% likelihood that you're going to win that bet. Well, when you win that bet, you get potentially more than what you put in. So when the bank turns in that golden egg and says, we're going to use this to try to earn more, you've just exchanged the low guaranteed interest for the opportunity to earn more. And these vehicles can earn 50% more interest, 100% more interest, 5 times more interest. It just varies according to the index that's used and the time period that occurs, as well as the vehicle that's used. So over time, here's how it works. Your elevator goes one direction, up, never down, right? A floor under your feet, never a loss in this part of your portfolio. This is part of a strategy I call the barbell, and we're going to talk more about that in our subsequent episodes. But for right now, I've given you an example of the kinds of vehicles that can both protect and grow your money at the same time, the same dollar, right? Not some of your money safe, some of your money growing, but the same dollars, both protected and growing. What is the compromise? There's always a compromise, folks, and that is it's less liquid on this portion of your portfolio. This is why it's not appropriate for all your money. We need to have other dollars free and liquid for needs that come up over time. But this is one of many strategies that we employ to help you obtain freedom of wealth, getting rid of the obstacle of market volatility and unpredictability. This is part of your retirement freedom review. I can't wait to sit down with you. It simply starts with a phone call. Just pick up the phone and give us a call at 720-372-0400. Again, that's 720-372-0400. I'd love to chat with you about how you can achieve financial independence from a biblical point of view. Or just check us out on the web at lordandrichards.com.
Investment advisory services offered through Lord & Richards Wealth Management, LLC.